You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast. We are looking at the UK's incredibly high-stakes autumn budget this week, where Chancellor Reeves has the monumental task of filling a fiscal hole estimated at somewhere between 20 and 35 billion pounds.
Right, and the real tension here is how she balances that against her own ironclad fiscal rules and, at the same time, avoiding a politically toxic income tax rate increase.
And that's all before we even factor in the expected downward revision of growth forecasts from the Office for Budget Responsibility.
Exactly. This is all going to shape the market's reaction, especially for gilts and the Bank of England's next move.
So by the end of this, you will understand what markets are demanding and what this budget means for a potential December rate cut. Let's unpack it.
It's the ultimate political tightrope walk, and you're absolutely right to frame it that way. What makes this so fascinating, I think, is that tension you mentioned between market credibility and political survival. Reeves has to prove to the markets that she has enough fiscal headroom, that margin for error, but she has to do it without hitting the average voter with those big headline tax hikes.
The ones that would break her manifesto pledges.
Precisely. So we need to unpack how she plans to square that circle, especially with those potentially devastating growth downgrades coming from the OBR.
Okay, let's get into it. We've established the gap is substantial, around 30 billion pounds, maybe even pushing 40. But let's look beyond just the number. What are the structural forces actually driving that massive fiscal hole? What wiped out her headroom?
The single biggest driver, based on analysis from the Institute for Fiscal Studies and others, is that anticipated productivity downgrade from the OBR.
Right.
And this is where tiny changes have these huge nonlinear consequences for the national balance sheet. Think of it like a brutal multiplier effect. We're talking about every 0.1 percentage point downgrade to trend productivity growth.
Yeah.
It adds about 7 billion pounds to that fiscal hole.
7 billion pounds. Just for a 0.1% shift in a long-term assumption. That is a brutal multiplier. It really speaks to how fragile the public finances are when they're built on these assumptions of future growth.
Exactly. And the expected downgrade isn't just 0.1%. The Institute for Fiscal Studies, the IFS, they think the OBR's revision could be around 0.3 percentage points lower than before.
So that's 20 billion pounds right there.
Potentially, yes.
Rare.
A direct structural cost of about 20 billion pounds just wiped from the headroom. Money that just won't be there because of lower potential growth. The Resolution Foundation is a bit less pessimistic, maybe closer to 14 billion, but either way, we're talking double-digit billions gone.
So she's starting 20 billion in the hole before she even begins to think about new spending.
That's the headwind she's fighting, yes.
Which makes it feel almost impossible. And yet we saw those reports that she U-turned on a major income tax rate increase. If the productivity downgrade is so catastrophic, how did she manage to pull back from the biggest tax lever she has? That seems like a huge political gamble.
This is where the mechanics get interesting, and where, short-term economic reality actually gave her a crucial, unexpected bit of breathing room. That U-turn is reportedly based on much improved nominal earnings growth forecasts.
Okay.
So let's look at the numbers. Back in March 2025, the OBR forecast 4.3% nominal earnings growth. But the real-world data we've seen for mid-2025, say July to September, has wage growth coming in consistently higher, in the 4.6% to 4.8% range.
So higher wages mean more revenue for the Treasury right now?
Immediately.
Through what? Value-added tax from higher spending, and of course through the existing income tax system. It's a short-term boost that kind of papers over the long-term problem.
Precisely. That uplift gives the Chancellor just enough immediate fiscal room to avoid breaking that really sensitive manifesto pledge on the core rates of national insurance, income tax, or VAT. The higher nominal wages are like a temporary fix, plugging part of the gap. Estimates suggest it could provide maybe an extra 8 to 10 billion pounds in revenue.
Which makes the difference.
It makes all the difference between needing a headline rate hike and being able to rely on these stealthier measures.
Okay, so that clarifies the political calculation. She avoids the big political grenade of a rate hike, but that 20 to 35 billion pound hole is still there, and she has to fund her own spending commitments on top of that. We know about the welfare U-turn, which is about $6.5 billion a year, and maybe changes to energy support. So what's the overall strategy to fix the net gap and keep the markets happy?
The strategy, from what we can tell from leaks and reports, is to pivot completely away from rate hikes and focus on maximizing revenue through less visible measures.
Stealth taxes.
Chiefly. Fiscal drag. Look, she only has three options, right? Borrow more, cut spending, or raise taxes. Given how strict she is on her ironclad fiscal rules, borrowing more is out. Breaching those rules would just spark a gilt sell-off, the exact thing she wants to avoid.
And big spending cuts seem just as difficult, especially after the outcry over previous welfare reforms.
Absolutely. The political fallout from that has made the party leadership extremely nervous about any major public spending cuts. So the focus is inescapably on taxation. The short version of the budget plan is to extend the existing income tax threshold freeze for another 2 years, pushing it beyond 2028.
But it's more than just that, isn't it?
It goes deeper. There's serious talk of also reducing the threshold where the 40p and 45p tax bands kick in. It's a kind of double whammy of fiscal drag.
This is classic fiscal drag, weaponized, inflation and wage growth, the very things that gave her the breathing room, now pull more and more people into higher tax brackets without her ever announcing an actual tax increase.
And that's the crucial political defense. She can argue technically that she hasn't broken the pledge on raising the rates, even as people's tax bills go up dramatically.
It's a game of semantics.
It is. She can say the basic, higher, and additional rates are untouched. It prioritizes keeping a manifesto promise over the real-world impact on take-home pay.
Okay, let's talk scale. If she uses these stealth measures, what's the overall fiscal tightening that markets are actually expecting? What's the number they need to see?
To meet her targets and satisfy the market, the consensus is pointing towards extremely significant tightening. One very detailed projection from Suggenin anticipates this tandem approach, adjusting national insurance and several income tax measures. They project the total tax raises needed will be about £39.5 billion a year.
Nearly 40 billion pounds. That is a staggering amount of money to pull out of the economy. It's a massive contractionary shock.
It is, and it's important to see where that money goes. So Sagan assumes just under 12 billion of that will be immediately spent again on welfare, energy bills, and so on, which leaves a net fiscal tightening, a direct brake on the economy, of around 28 to 30 billion pounds per year.
So she raises 40 billion, spends 12, and uses the remaining 28 billion to fill the structural hole and build her headroom. That 30 billion net figure is huge. What does applying a brake of that size do to the UK growth outlook, especially when the OBR is already about to downgrade it?
And that is the critical risk the market has to grapple with, this level of contractionary policy. It comes at a very challenging time. If the OBR is already saying the supply side of the economy is weaker, then applying a 30 billion pound brake on the demand side makes achieving any real growth substantially harder. It could lead to stagnation.
Right.
And that feeds directly into the market's assessment of long-term risk for UK assets.
That economic trade-off is central to this whole budget. So speaking of market assessment, let's talk about the fiscal rules themselves. Reeves calls them ironclad. Can you just remind us what they are?
Of course. Understanding these is crucial because they define her self-imposed discipline. There are two main rules. The first is the stability rule. This requires the current budget, that's day-to-day spending versus tax revenues, excluding investment, to be in surplus in the final forecast year, which is currently 2029-30.
That's the one her headroom is measured against.
Exactly. And the second is the debt rule. This requires public sector net financial liabilities, or PSNFL, to be falling as a share of GDP in that same year.
And why does the market care so much about these specific rules?
Because they're the government's promise to keep its house in order. Breaching them signals an inability to manage the public purse. The debt rule especially is the ultimate measure of sustainability. If the market thinks debt to GDP is just going to rise forever, it means financial instability. And that means higher borrowing costs for the government, and eventually for everyone.
And the headroom she left herself last time in the spring statement was razor thin. It gave her no room for error.
Extremely thin. It created a lot of anxiety in the market. Her headroom for the stability rule was only 9.9 billion pounds. The OBR itself called that a very small margin.
I remember that. It weighed on Gilts at the time because it just screamed, another tax rate is coming.
It did. The margin on the debt rule was a bit better, about 15.1 billion, but still not much wiggle room.
So the immediate goal of this budget must be to increase that headroom significantly to regain confidence. What's the magic number the market is looking for?
Precisely. The goal is to break that doom loop caused by the minimal headroom. The consensus band for adequate headroom is somewhere around 10 to 20 billion pounds. The expectation is she'll aim for well above the old 9.9 billion, probably topping 15 billion. Reaching 20 might be a stretch, but if she can leave about 15 billion in headroom, the market would likely be satisfied. It would offer some much-needed breathing room.
This brings us to the current economic backdrop. She's delivering this budget into an environment of pretty mixed signals. What's the overall picture of the UK economy right now?
The picture's generally soft, with definite downside risks. It reinforces the case for the Bank of England to consider easing policy. The latest snapshot we have is from the November flash PMIs, the Purchasing Managers' Indices, and they were softer than expected, especially in the crucial services sector. S&P, who compiles the index, they noted that some of this economic malaise, that was their word, could be companies just pausing spending ahead of the budget.
A classic pre-budget pause. But is there a real risk that pause becomes something worse, especially when you throw a £30 billion contractionary hit on top of it?
S&P certainly warned that there's a real chance this pause may turn into a downturn, and that fear is backed up by the output data. The September GDP print undershot consensus, coming in at minus 0.1% month over month, and third quarter GDP was revised down to just 0.1% growth.
So sluggish at best.
Very sluggish.
Yeah.
The economy is highly sensitive to any shock, which means that 30 billion pounds of tightening will be felt very, very acutely.
On inflation, though, we finally saw the number everyone was waiting for.
Yes. The Consumer Price Index, CPI, finally dropped below 3.8%, coming in at 3.6% in October. That was in line with the Bank of England's forecast, and it tipped the balance further towards a December rate cut.
But we're still waiting for the November CPI report, right?
We are. That comes out just before the December Monetary Policy Committee meeting, and it will be the final piece of the puzzle. But the trajectory is clear. Inflation is falling.
And what about the public finances leading into the budget?
Public sector net borrowing, the PSNB, has continued to be a challenge. The deficit for the April to October period is at £116.8 billion.
Which is way above the OBR's forecast.
Significantly above. Their forecast was $107 billion. This overshooting deficit puts direct pressure on the Debt Management Office, the DMO, to reevaluate how much it needs to borrow.
Okay, so let's talk about the DMO remit then, because that directly hits the gilt market. What are the expectations for the revised gilt issuance?
Well, because of that overshoot in the cash requirement, the CG&CR, there's a widespread view that the gilt remit for this fiscal year, FY25, will have to be revised up a bit. Maybe by £10 billion, some say as high as 15.
An upward revision in the short term. That's usually bad news for gilts, right?
Yeah.
More supply.
It is, and the DMO will try to manage that announcement carefully. But here's the nuance. The market's focus is going to be far more on the next fiscal year, FY26-27. Morgan Stanley, for example, expects issuance for that future year to be around £267 billion.
And why is that forward-looking number so much more important?
Because it would represent a clear, marked year-over-year reduction in borrowing compared to this year.
Oh, okay.
A significant reduction in future borrowing is the definitive signal that the government's consolidation plans are serious and credible. It would be highly welcomed by the market and could easily offset the bad news of a small upward revision for this year.
It tells the market the pain is temporary, not structural.
That's it, exactly.
Yeah.
If that $267 billion figure is credible, it signals that the fiscal tightening is actually working.
Let's circle back to the policy choices. You mentioned these fiscal drag measures, especially reducing the thresholds for the higher tax bands. How significant could that really be? And what's the political cost of hitting the middle class with this kind of stealth tax?
Lowering the thresholds for the 40p and 45p bands is, well, it's politically genius but economically brutal. It's a highly effective way to capture more middle and high earners without touching the headline rates. When you combine that with freezing the basic rate threshold, which pulls millions of lower earners into the tax system, it's an incredibly powerful pincer movement.
So you're extracting maximum revenue from wage inflation.
Exactly. You're accelerating it. You're capturing workers who might not even think of themselves as high earners. And in terms of revenue, while it's complex, freezing the basic rate threshold alone raises billions annually. Reducing the 40p threshold by just a few £1,000s could net several billion more immediately. These small tweaks are absolutely essential to get to that target of nearly $40 billion in tax raises.
But doesn't that feel like a massive risk point? If you use one big lever, like a rate hike, the revenue forecast is pretty solid. But if you rely on a dozen smaller technical levers, the calculation seems much more uncertain.
That is absolutely the central risk factor the market will be scrutinizing, and it's a valid critique. These threshold-based measures introduce significant uncertainty.
The government is basically just betting that wage growth and inflation stay high enough for long enough.
They are. And if the OBR gives a highly optimistic assessment of the revenue from this cocktail of small measures, the market might just push back and question how credible the headroom really is. If the market thinks the headroom is built on shaky inflationary foundations, it increases the risk of another forced, chaotic fiscal event down the road, which is exactly what the Chancellor wants to avoid.
So the market isn't just judging the headline number, but the quality of the policies used to generate it. Okay, let's tie this all together and look at the market reaction. Assuming Reeves avoids any big surprises, sticks to the rules, gets headroom above 15 billion, what's the path of least resistance for gilts? And
Assuming that best-case scenario, strict adherence to the rules, decent headroom, market confidence, the path of least resistance for gilts is likely higher, which means yields moderate or fall. This is rooted not just in the budget's discipline, but also in the anticipation of more easing from the Bank of England. The fact the government is applying a £30 billion brake on the economy lowers the risk of future inflation, and so it lowers the perceived peak for the bank rate.
And conversely, what if she breaches the rules? Is that even a realistic scenario?
It would be highly unexpected, almost unthinkable, given how much political capital she's invested in them, but a breach would be the nuclear option.
A massive erosion of confidence.
Instantaneous. It would almost certainly spark a significant sell-off in gilts and UK assets. Investors would conclude fiscal discipline has been abandoned. This is why the proactive consolidation she's doing now is seen as the much safer option.
And what about the currency? Sterling seems relatively calm leading up to this.
That's right. Option pricing suggests maybe a 1% swing in either direction for cable. Volatility is muted because the market is pretty comfortable with the broad outlines of the budget. Painful but necessary consolidation via stealth taxes. The real moves will come if the specific numbers surprise.
Now, the biggest external influence, the Bank of England. How much does this contractionary budget influence the Monetary Policy Committee's decision on a December rate cut?
A great deal. Taking $30 billion net out of demand, combined with the OBR's lower growth forecast, absolutely increases the odds of a 25 basis point cut in December. The market has it priced at about 85% probability, and this only reinforces that.
But the Bank of England Governor Bailey always emphasizes that their focus is on inflation and wage data, not fiscal policy.
That's true, and that independence is vital. Bailey has said he's comfortable with the market pricing a terminal rate around 3.5%. However, a substantial fiscal hit like this could potentially skew that outlook even lower. If the MPC judges the deflationary shock to be stronger than they anticipated, it could pull that terminal rate forecast down, implying more rate cuts sooner.
But the bar for the budget to fundamentally change the immediate December decision is high, isn't it? The market has already priced in consolidation.
Very high. The MPC is laser-focused on the upcoming November CPI data. The budget reinforces the existing easing bias, but it probably doesn't dictate the timing of the very next move unless the OBR reveals some catastrophic growth shock.
Okay, while the financial risk seems controlled, we can't ignore the political risk that could derail this whole thing. Let's talk about the internal labor fractures.
This is a huge risk factor and one that markets often ignore at their peril. In the week before the budget, reports emerged that the Tribune Group, a significant left-leaning faction of the Labour Party, had consolidated the 80 MPs needed to trigger a leadership contest.
80 MPs. That's not just some grumbling. That's the constitutional trigger for a serious internal battle, a very serious sign of deep dissatisfaction.
It is. Now, they haven't decided on a nominee to actually challenge the leader yet, but just the fact they have the numbers is creating concern among investors.
And their motivation is this budget.
Directly. They fundamentally oppose this austerity and the rigid adherence to fiscal rules, which they see as limiting public investment and driving inequality through things like fiscal drag. The risk, from a gilt market perspective, is profound. A successful left-leaning successor could just drop those ironclad rules to increase spending funded by more borrowing.
And dropping the rules means higher borrowing, higher gilt yields, higher debt costs, and then a chaotic forced consolidation, a repeat of past crises.
Exactly that cycle, the sell-off, the higher yields, the forced U-turn. That is precisely what Reeves is trying to prevent with this preemptive consolidation.
So the budget is an insurance policy against her own party.
In many ways, yes. It's an attempt to make the party look financially responsible before the internal dissent can fully take hold.
Beyond the leadership threat, what's the next big political flashpoint for markets?
The May local elections. If the leadership contest doesn't happen right away, the performance in those elections will be the next major test of the public's acceptance of this fiscal tightening.
And the polling data is not looking good for Labour, even as the incumbent government.
It's worrying, to say the least. YouGov polling for a general election shows Labour on 19%, trailing Reform UK at 27%, with the Conservatives close behind at 17%.
Trailing Reform UK, that's a radical inversion of normal politics.
It suggests extreme volatility and dissatisfaction. It reinforces how difficult Reeves's job is. She has to consolidate the finances without inflicting so much pain that she drives even more voters away.
She has to secure that $15 billion in headroom, but do it in a way that doesn't cause a public or internal rebellion, hence the fiscal drag.
That's the tightrope.
The success of this budget, then, isn't going to be about spectacular measures, but more about its quiet competence in managing this balancing act. It sounds like a budget designed purely for survival.
It's entirely a survival budget. It's about minimizing volatility, satisfying the debt markets, and keeping internal critics quiet just long enough to get through the next political cycle.
So for you, listening at home and preparing for that November 26th announcement, what are the absolute must-watch parts of the budget that will tell you where the market is going?
You need to watch three things. First, the size of the fiscal headroom. That number needs to land convincingly above £15 billion to settle nerves. Second, the OBR's revised growth and productivity forecasts. The depth of that downgrade will dictate the long-term borrowing path. And finally, the DMO remit for the next fiscal year, FY26-27. Look for a clear reduction in borrowing. That's the positive signal gilts are waiting for.
That has been a critical review of the path Chancellor Reeves is taking to secure her fiscal headroom ahead of the autumn budget.
Appreciate you tuning in to understand the nuances of the UK's political and fiscal tightrope walk.
And before we wrap up, here's one final thought for you to consider. If this whole consolidation relies on the stealth tax of fiscal drag, what happens if we face a period of low inflation and low wage growth? The entire strategy rests on high nominal earnings. If that stalls, the headroom collapses, and those headline rate hikes she worked so hard to avoid could become completely unavoidable. Thanks for listening. Join us again next time on the Financial Source Podcast.